Well, hi everyone. I'm Caitlin Muldoon.
And I'm Susan Geist.
Just a quick note about who we are in case you're new here. Susan and I co-founded Rising Femme Wealth with a mission to make more women financially independent. And we've been doing that through our community, through educational programs, and through coaching. And one of the things that we love is how much the women are in our community really open up about their money stories, their money goals, and their money questions. We love that we've been able to be a part of conversations where women are really able to talk about money. And that's why we decided to host our Wealth Wednesday series. This is a chance for women to join these free calls and have their voices heard and their questions answered when it comes to all things going on in the world currently about money.
Yeah, and we wanted to meet today because things are kind of weird right now with the economy. We're seeing things moving in different directions than they normally do. We've just, finally had the first interest rate cut in a long time. And we've got an administration that seems to be very unpredictable. So we wanted to just kind of have a conversation today about what's going on, what we're seeing, and things that we can do to feel better about our investments right now.
Yeah, absolutely. And I think that a good way to put that into context is maybe to talk about what happened recently, just a couple weeks ago. You've probably heard it on the news that the Federal Reserve cut the Fed interest rate. And that is not anything new. You know that the Fed meets quarterly, and we were certainly expecting a slight rate cut. And we thought that it might be important to talk about what's going on in our economy and what's going on with the stock market, and perhaps in the context of the federal interest rate, because I think that it's important to understand why this Fed rate cut is in the news to begin with. And if there is a Fed rate cut or a Fed rate hike, why does that matter to us? And really, what's the point of it all? So Susan, do you want to give us a little bit of a very, very high level background on what that even is to begin with?
Yeah. So the the Fed uses interest rates, right, to either stimulate the economy or tamp down on inflation. And I think, Caitlin, you actually have a graphic maybe we could pull up
Yeah, totally.
that shows how this works, right? So when prices are going out of control, we see inflation rising really quickly. The the Fed wants to do something to kind of put the kibosh on that, right? We've seen other countries where they didn't have that tool and their inflation just goes out of control. I should have brought it with me today for this meeting. I have a $1 billion bill from Zimbabwe that I got when I was in Africa. That their inflation just was completely bonkers, right? Went completely out of control and just tanked their economy because the currency just exploded. And so, we don't want that to happen here in the US. And so a way that the Fed can do this is by raising interest rates and making money more expensive to borrow, right? And so we saw how it pulled back on prices, right? Especially you could see it in the housing market as people were trying to take out these mortgages. The cost of borrowing that money like doubled, right, from what it was just a few years ago. And so we finally saw the prices of houses starting to come down. And you could see that in other goods too. And you can see that with businesses, because businesses are always trying to borrow money, right, to grow. And so if it's more expensive for them, it's going to slow that too. And so it's a good tool that the Fed can use to control how the economy is doing, but they also really have to pay attention not to pull it too hard or the economy really starts to drag, right? And so we're starting to see that now. We're starting to see these businesses having to cut jobs, and that's partially due to the cost of borrowing money, partially due to tariffs. It's due to a lot of things. But we are
Yeah.
seeing a pullback now in the economy. And that is what one of the things that led to them cutting the rate now.
Yeah, I like to think of like the Fed as being able to use a faucet, and it's like the interest rates are a tool as a way to control flow of water in our economy, right? Like a rate cut is like turning a faucet on, and severe rate cuts would be really, really turning that faucet on, a crank. We did not see a severe rate cut recently. It was only a quarter of a point. But still, we're seeing that faucet being turned on a little bit more. And that's a nod to try and say, let's have money flow more easily, right? When rates go down, like Susan was saying, that allows, it kind of encourages consumers to buy more. It encourages investors to invest more. Um, when interest rates are low, real estate investors might want to go and buy more property because you're seeing more competitive um, mortgage rates. And this is really just a way for the Fed to be able to use a tool to say, all right, we want you all to go out there and spend more money. We want to boost up the economy. Whereas the other side of that would be tightening up that faucet, and that's the Fed's tool as well. And that would be when the Fed really raises interest rates. And we saw that soon after the pandemic when the Fed recognized, like, oh my gosh, inflation is out of control. People are still spending. We need to really stop that and get inflation under control because eventually everything's going to be way too expensive. And that is not great for the economy either. So like Susan said, there's sort of like this balancing act that the Fed has to take in order to make sure that the faucet is in just the right place to make our economy work the way that it's supposed to.
Yeah. But we're also seeing some strange things happening, right? So normally we would see the interest rate lowered and the stock market is going to take off, right? Because people will say, oh, well, these companies now they can borrow money at a lower rate, and so they're really going to grow, and so this is great for the stock market. And we are seeing that. But something else that we're also seeing that we don't normally see at the same time is that the value of commodities, especially like gold and silver, is also going up. And so normally they're going to move in opposite directions, right? So when people are very excited about the economy, they're excited about businesses growing, typically these stable assets that people buy in times of bad economic situations will go down, right? So we'll see people really putting a lot of money in like the S&P 500 and not buying these stable assets as much, like commodities. But what we're seeing is that both are going up. So we're seeing this really interesting situation where people are excited about the economy, but also afraid, right? So the commodities tend to go up when people are afraid of what's happening in the economy. They're afraid that the stock market's going to go down. And so they start investing in like metals, oil and gas, consumables, things like that tend to be more stable when the economy falls. So we're in this kind of really weird situation right now. And so we are getting a lot of questions from people about where to put their money, right? Especially I have, a lot of friends who have been traveling abroad recently, and they're noticing that the dollar is not nearly as strong as it was even just a few months ago. And so they're like, oh, what do we do now? Should we be buying, euros? Should we be investing internationally? Should we be buying gold? But they don't want to get out of the S&P 500, right? Because that's also been going gangbusters. And so we're in this really kind of strange place where at the moment, everything is going up. but there's this question of how long can that last? Um, because
I'm curious.
obviously, yeah.
I'm curious what the sentiment is, even just on the call. Um, so if anybody like wants to come off of mute or even just throw into the chat, if you're feeling like great about the economy right now, if you're feeling really scared about the economy right now, or if you're like, I don't know, it's just kind of it really things feel sort of like normal.
I'll speak up.
Sure, Elizabeth.
Um, I personally want to get out of some of my investments that are US and take some of my money and put them in like, minus US funds just because it's just so whatever is happening. And the dollar falling is extremely disturbing to me. And I also wondered, this whole about investing in gold and all these commodities, as you call them. I wonder how much of that is an influence from just boomers because, I am a boomer, so I can say it. That they tend to like those things because, it's like something you could have, like, you know what I mean? So I wonder if that's something that boomers will do that younger generations just won't even think about.
That's such a great point. And I think gold is something that I know we've talked about a lot because as Susan mentioned, it's one of those indicators when we see, hard goods going up, usually that can be an indicator that the economy might be taking a turn. And um, I think that that will continue to be an indicator, but I am with you in that I'm not so sure how much the younger generations are going to continue to invest in certain commodities, such as gold, and certainly not in the same way that people historically have. I mean, I know, Susan, you've told me about friends especially who come from immigrant families, like they are first or second generation, and because they've witnessed their parents wanting to have hard goods during times of economic turbulence, like I want something I can hold on to. You have friends currently who are like, no, I want to go and buy physical gold. Whereas we know that you can go and onto your brokerage account and you can trade for commodities funds and you can trade for gold funds and you don't actually have to have physical gold in hand. So I think that there's a trend favoring those funds over having, your own physical ownership of gold. And then one thing that I'll say is I feel a little differently than I know Susan on this. This is one place where we feel a little differently. I think that for my peace of mind, I don't feel like I need to have gold as much in my portfolio. And I feel that gold over the long haul, it just doesn't have the same returns as if I were to just have a portfolio that is diversified between international and US funds, between small cap and large cap, between growth and value funds. So I don't place as much emphasis on gold. I do have hard, real assets in my portfolio through real estate. And for me, I feel like that satisfies that different direction and different diversification that separates itself from the stock market. So I feel like I don't need to invest in gold, especially during times like right now. Maybe there will be a time where like, oh, we're in a pinch, that doesn't feel good. And when we come out of it, if gold prices fall, then maybe I'll be like, you know what? I want to feel better next time this happens. So maybe I'll invest in gold now while it's more affordable and then I can just feel better later. But the rational side of me says don't do that because it's not the same return. Like, yeah, it might do better during times of recession, but for me in the long run, I don't feel like gold has the same return as a portfolio that's diversified between US and international funds and small and large cap, like I said. I'd like
Yeah.
to hear your thoughts on that too,
Well,
Susan.
I mean, I agree with that. I think that's definitely been the case up until like this past year. Gold has not performed great. It's gone up, but not at the rate of like the S&P 500. But they have started carrying gold bars at Costco now, and they keep selling out. So that makes me think it's not just the boomers, as you say,
Mm.
Elizabeth. that are buying the gold bars. I think a lot of buying gold is psychological, right? So we're buying it as, you know, a sort of hedge against the fear about the economy, right? Because that is an asset that we know people will run to as they get afraid of what's happening with the stock market. And so that's not even buying it for necessarily the intrinsic value of the gold, right? It's a psychological purchase. And then, like Caitlin was saying, I do have friends who are buying physical gold because they have had to flee their country in the past and come to the US, and they wanted something physical. They needed to have something physical they could grab and take with them and trade, right? For food, for housing. And so they did want to have physical gold, and they are stockpiling physical gold again. But I would say, I mean, there's a lot of downsides to that, right? Because you have to have a place to store it, and you've got to get it insured. And then when you try to sell it, that's usually you lose money on that transaction. So there are a lot of downsides to that too. But I feel like right now it's helpful to have at least a small portion of a portfolio in commodities, just because of what we're seeing with, you know, both commodities and the stock market going up, right? So it's kind of the whole diversification, right, of your whole portfolio. Is I'm not getting rid of the big chunk that I have in the US market, but I have been adding more international stocks, more gold, more commodities, more consumables. So I'm diversified more across different asset classes than I was before all of this started happening. I was pretty heavy in the S&P 500, and that's how I've always been. S&P 500 and just, you know, like your VTI standard index fund across the whole stock market. But now I'm starting to add a bit more of these other asset classes, you know, like 5% or so here or there, just as a hedge against whatever may be coming in the future with this very unusual situation that we're in right now. And Caitlin, I see there are a couple questions in the chat there.
Yeah, I see questions about investing in non-US assets as a way to take advantage of a falling US dollar. And I would say overall, it's always a good idea to invest in non-US assets, to have a slice of that in your portfolio just as a way to stay diversified. And and then one thing I want to emphasize as we answer some of these questions is, first of all, none of this is investing advice, because we are here as a group to provide information and education. So we're not giving personalized investing advice through this call. But one thing that we'd like to share are insights about ways that you can mitigate risk when we see a lot of downturn, or potential downturn in markets. And one strategy to really keep you grounded is to find an allocation in your portfolio that you feel good about. And one thing that I will say is that in the last year, I've been changing my own personal allocation so that it is heavier weighted in international funds. And that's something that I've been doing because I have been getting a sense that things in our economy are really changing. And, you know, what we're seeing from our GDP might not actually reflect what's really going on in the US economy. And that has made me feel like, you know what, maybe I do just want to have more in international funds. And we're seeing a lot of strong international markets too. So that makes me feel good about having a stronger international allocation in my portfolio. But that's not to say, hey, I think that whenever something crazy happens and you see the stock market dip, that should be your time to just like really yank on a lever and say, I'm going to go all in on, you know, this particular asset class, or all out on that particular asset class. Really, it's a smart move to be able to understand, you know, what are the asset classes that make you feel good to have a portfolio that says, hey, at any given time, something might be going really well in this one area and really poorly in this other area, but I have enough diversification in my portfolio to make me feel grounded enough that I can say, yeah, I'm losing over there, but I'm still okay over here. And that allocation should make you feel like you don't have to make any drastic changes when something happens, like, like if a crash happens or if there's an economic policy that is introduced. So I want to emphasize that as we go through some of these questions, and I want to make everybody feel like if you're not making any drastic changes right now, that doesn't mean that you're doing anything wrong. It could mean that you feel really good about your allocation, and that's the goal. You should feel really grounded in that allocation.
Yeah, and I think it's such a good point that in your portfolio, you should always have things that aren't performing as well, right? If you're well diversified, you're going to have things like Caitlin said that are doing well and things that aren't doing as well. And an important thing to remember is not to dwell on the ones that aren't doing as well, right? And I think that's that negativity bias, right? That we all have. So like right now in my portfolio, real estate is not doing very well. The market's been down. And so it's hard for me to not sit here and beat myself up over, this percentage of my portfolio that's not doing well. But then I've got, other things that are doing amazing. And so I think that's an important part of, being an investor is getting your head around the psychology of that, right? And being patient with things and being tolerant of things, that even aren't performing as well, because that you have a diversified portfolio. There are some things that will do well at one time and other things won't do as well, but then you may not lose all of your money if the markets turn a different way, right? Because you're well diversified. And so I think that's a really important piece, is the psychology of everything, right? And getting your head around that.
Yeah.
And I see we have a question in here, Elizabeth, about lithium and rare earth metals. I have mixed feelings about those. I know lithium has been a little bit oversupplied. I think they sort of foresaw the demand for it coming up with, it's used in electric vehicles and like wind power. And then of course these AI data centers. And so I think they were already ramping up demand for it. And then I'm not sure with this current administration what's going to happen, right? I know the electric vehicle tax break just ended yesterday, I believe. So we may see less of those produced. Of course, this administration is not a big fan of wind power. So we may see less of that here, at least here in the US. So I don't know. What do you think about it, Caitlin?
My thoughts on this are always, and I think I sound boring in this regard, but I group that into my like curiosity portion of allocation. So there's a portion of my portfolio where I say, I want to like kind of play around here a little bit and gamble on something. I'm curious and I feel like there's maybe an industry or some materials that I think are really going to take off. Or even there's a company that I really like and I want to reward them by investing in them. And the reason that I allocate a really specific and small portion of my portfolio to that is because that's the allocation where I say I can't expect that to take off for real. Like if I invest money in that, I have to be okay with losing that money. So I treat it a little bit differently than like the crypto bucket because it's maybe not as risky as I perceive crypto to be. And it's something where I feel like, I'd like to see where this goes. And at the same time, I'm not really putting a lot of my investments in there. Not even a strong portion of my investments. So I always like to have just like a little play portion of my portfolio in that regard. So with that said, I don't have like a designated allocation that I put into metals or specific commodities in that way. I tend to lean towards the allocation that I've mentioned in terms of U.S. international, small, large cap, value, growth, and blend.
Yeah. And those risky investments, they are a good candidate for adding stop losses onto your portfolio too, right? So that's when you'll go into your brokerage account and you'll set up a stop loss sale that says, sell the stock if it drops by 20%, right? And it'll automatically sell it for you. So if you're investing in things that tend to be a bit riskier, like if you're taking a flyer on some startup you've heard about, but you're not sure, is it going to shoot to the moon or is it going to go to zero? That would be a good candidate to put a stop loss in your portfolio. And I do that on some of mine. I'm actually going to talk about this in the newsletter tomorrow, because Rivian and Firefly Aerospace are two recent startups, right, that originally did really well when they had their IPOs, and now the stock has just tanked. And so, if you had put a stop loss on there, that could be the difference between just losing a little bit of money and losing almost your entire investment. So that's a good tool on those riskier investments that you're just kind of using your play money on, and you don't need to use stop losses on like your bulk, like index fund investments, like the things that you have for the long haul. You don't want to put stop losses on, because even if the stock market drops, typically it rebounds quickly, and we don't know when that rebound is coming. But if you miss that rebound, that can really damage your portfolio. So those stocks we just want to hold on to and just ride the waves on those. I see we have a question from Priya here. With the workforce now so focused on AI, is there any recommendation on what type of investments we should focus on? That's a really interesting question. So we are seeing some tendencies towards a very similar type of bubble like we saw with the dot-com bubble, right? So we've got these AI companies like OpenAI, right, is the biggest one, that are taking in a lot of investor money, and they are not profitable yet, right? And we're not quite sure what's going to happen. We did see this during the dot-com boom and bust. And so I think in a lot of these cases, the real winners are the companies that, like in a gold rush, right, that are selling the shovels, right? They're selling the buckets. And so the companies probably like NVIDIA, AMD, Intel, these ones that are providing a lot of the chips, a lot of the infrastructure, that may actually be where the big returns are. But I don't know. Like, this is not investing advice. This is just my take on this. I would feel better investing in those companies than going straight into the AI companies personally. But Caitlin, I'm interested to hear what you have to say.
So my feeling on this is that if you are invested in funds that are tracking the S&P 500 or the total US stock market, you're invested in both AI companies as well as the shovel companies, right? The chip companies. So you're probably already getting a big slice of AI in your portfolio just by investing in those funds, such as like VOO, VTI, the very common index funds that we see, which I believe are really oversaturated in big tech right now, which is almost synonymous these days with companies that are investing in AI, be kind of ahead of the curve and in creating different AI models, and then also those companies who are supporting it through chip technology and data storage. And so, my feeling is that there's a very good chance that you're probably already invested in those companies. The question might even be, are you over invested in some of those companies? So, we know that AI is where our future is going. Just like e-commerce didn't go away, but like we saw so many e-commerce companies just really bite the dust during the dot-com bust, because it was just very saturated. And I believe there could be the same thing that's happening now. So, and we don't know which of the companies are going to wind up on top, and then which of the companies are going to fall. So it's unpredictable right now. We're seeing so many strong returns, so it's hard to say pull out of that particular sector because it's been performing so well. But I think there is a lot of question around, is that really sustainable? And I think the answer is no. I don't think anybody really believes the answer is yes, but nobody knows, okay, well, who's going to wind up on top? So what's the right balance to strike right now? So I personally believe that the right balance is keep your assets in the S&P 500, in those big tech companies, but make sure that you have other assets elsewhere, and I wouldn't say, go pull everything out of the S&P 500 and go all in elsewhere, like in small cap or international. But I would definitely say, like, maybe look at your allocation. And if you are really heavy in the S&P 500 or the total US stock market, that might be a good sign to say, would I feel better about reallocating? Like if something happens that really affects these markets, which if something happened to AI, that would really shake up the S&P 500 and the total US stock market, because those are so heavily weighted in those big AI companies right now. Then what is your alternative? What's your fallback option? And if you're 90% allocated in those markets or funds that track mostly the holdings that those markets are weighting, then that might be a good sign to say, okay, what's my backup plan? How can I maybe allocate more beyond that?
Yeah, no, that's super helpful. Thank you. Yeah, I just was curious because, like I'm actually trying to train myself up for AI jobs because like what I used to do isn't there anymore, right? So as I'm skilling up, I was just wondering if I should also be thinking about investment the same way, but I'm invested in S&P 500 mostly, and then I also have the Nvidia and other stocks, just kind of separate stocks, and they're doing really well. So I'm just going to keep it as is, but it's not a big portion of my portfolio. So I feel pretty safe with that. But is there like like as we're talking about economy not being stable, we're talking about uncertainty, right? Is there like a general ratio that is recommended? Like both of you spoke about real estate, right? So that's not doing so hot right now. So is there like I don't know, is there like a mix that would be like kind of a safety for you to have? So if I had $1 million, what portion of it should be in stock? What portion of it should be allocated into other things? Like, do you guys have a general kind of guideline in that? And maybe we've already spoken about it. I'm sorry, I'm in between making my lunch and other things, but I apologize if this has been answered.
No, I think a lot of it has to do with your time horizon, right? So, and that makes such a big difference in how you should allocate your portfolio, because if you're, 25 years old, you've got this really long time horizon before you're going to retire, you might as well go ahead and put 90 or even 100% of your portfolio in the stock market, right? Because you've got time to recover it. If you are in retirement or really close to retirement, you want to pull back on that a lot, right? Because you want more stable assets. So you want to have more in things like bonds, treasuries, things that are going to be more stable and won't suddenly drop. Yeah, so that's a big thing. I would say also the risk tolerance too plays into it, right? Right now, I want to say my portfolio, trying to think percentage wise, I have too much real estate right now. I'm trying to rebalance. But it's hard to rebalance right now in real estate because real estate is down, right? So it's like, I want to rebalance this, but my real estate, this is a terrible time to sell real estate, as you know, right? So there's that piece too, right? So I'm probably maybe 50% stocks, I would say, and maybe 40% real estate and 10% other stuff, bonds, cash. But that's just me. And I'm not saying that's an ideal portfolio. That's kind of where mine has landed right now with the growth in the stock market and real estate going down. It's kind of landed in that portfolio. Caitlin, what would you say?
Yeah, I would say I agree. The reason that we don't typically say like this is a general guideline of a great allocation is because for one, yeah, I don't whatever your risk tolerance is, time horizon like really has everything to do with it. And by time horizon, we mean how long until you think you're going to need to use that money, not just how long until you expect to retire, but if you're early retiring or if you're like, you know what, I'm gonna go and move out of the US and go maybe work abroad and um, just let go of my regular income, that would also that's part of your time horizon, right? You might need to fall back on using your portfolio. So that should be incorporated in your time horizon. So if you're thinking, in the next 5 years, I want to scale back from my job and I want to be able to rely on my portfolio, then maybe a 90%, growth stock allocation is not the safest if you know that within the next 5 years, you're going to want to be able to use that because we know with, you know, uh, large growth stocks, there's a lot of volatility there. So you could see a lot of growth, but you might have periods where there's, some decline and you want to be able to ride out that period of decline and see that growth again before you use the money from that portfolio. So 5 years, I would say, is a pretty short time horizon, and you'd want to give yourself a little extra buffer beyond 10% of your portfolio. So one thing that I'll say, because I've brought up US versus international so much, is um, I kind of like an allocation of, personally, again, not for you all, but for myself, is an allocation of roughly 70% US to 30% international. And one thing that I'm doing is sort of leaning towards growing the international piece. Some people like 50-50. And that has always felt riskier to me just because
Yeah.
I've seen so much growth in the US markets. But as of lately, I've been starting to change my mind a little bit, a little bit. Um, I don't know that I'll really end up at a 50-50 allocation because honestly, to me, that seems pretty aggressive towards international. And that's, again, my personal take. But I know people are, and this is where we go beyond time horizon and really risk comes in. People have different risk factors, and I'm talking risk, as it might pertain to certain asset classes and risk as it might pertain to the stock market in general, or risk as it might pertain to the US economy. And so some people feel like I do not trust the US economy. This makes me so nervous. And for them, it might be better to take a higher allocation of international funds. And it might be better to take a higher allocation of real estate. And then on the note of real estate, my portfolio has always kind of been out of whack because I started investing in real estate really before I started investing in my own brokerage account. So I had a way, I was talking to advisors who were like, you need to get out of real estate. You're crazy. Sell these properties and buy stocks. Um, I saw my public asset classes go up after a while because I started investing more in my 401k and IRA and then also in a brokerage account. But still, my real estate allocation is so out of whack because you take out loans. Oh, I took out loans to buy real estate. So I wasn't using as much capital to buy my real estate as I was using to buy US stocks, for example. So, and then the real estate was really starting to appreciate, and then I have loan pay down. So that makes it really can blow an allocation out of proportion when you start to compare stocks versus real estate. And I think it's really tough to give guidelines on this is how much you should have in real estate versus this is how much you should have in public markets because people get into real estate if they do, and in times that make sense for them, in different opportunities, in different circumstances. So it's really hard to just kind of make an overall guideline on that.
Well, I want to ask you, Caitlin, what your opinion is of real estate right now. So we know the real estate market has fallen, so it's not a great time to sell.
Right.
But what do you think about buying? Do you think now is the time to get in? Do you think it's too early?
So I would say that if you're in a phase of real estate, which I am not anymore, like I feel like I'm in this part of real estate where I'm lucky enough to have a lot of stabilized assets, and I'm getting cash flow from them, and I'm in a position where I'm like, I don't need to sell that asset because it's cash flowing unless it's like a real problem child. And I want to get out of that asset. Um, and therefore, I might sell, I might choose to sell now, because it looks like there might be, a little bit of a buyer jump in this next quarter. And as far as a buyer goes, if I was a real estate investor and I was really looking to grow my portfolio, then I would say now might be a good time to start considering getting serious about that if you already made the decision, I want to grow my portfolio. And the reason that I say that is just because of all of the seller concessions. We are at historic highs in terms of concessions that sellers are offering. So sellers are offering so many concessions, it can result in rate buy downs, and price decreases. So as a buyer, you might find yourself in a pretty good position now that might not be around, next year, just because we don't know what the future holds. But with that said, that's all based on the assumption you've already made up your mind you want to grow a real estate portfolio. And if you're not there, I would say I would question, why do you want to do that when you have opportunities right now in other markets where you're getting better returns and there's a lot of uncertainty around real estate. And then I guess, to be fair, one thing that I should share is that because I already have real estate, I feel good about it. I do feel like it's a good play to have those real assets from a legacy perspective. I like that, my children could eventually, if we wanted them to help us manage these properties and we wanted them to be able to, have own their own real estate, to be able to use some of these properties that we have as a way to leverage, and help grow potentially, a portfolio for them one day. I like the idea of having that option just because the housing market has made me feel like, what if in 20 years real estate is completely unattainable for most people? So, which is obviously, it's not the direction that I want to see us going. But if it is where we wind up, it does make me feel good knowing that I do have some of those assets. So, um, to be fair and not totally like, kick down the thought of becoming a real estate investor, that is the way that I feel now. Although
Yeah.
it also seems unfair because I'm saying that as someone who was able to take advantage of some low interest rates and build equity, and not be buying at, some of the toughest times.
Yeah. I would say, as annoyed as I am right now about having this huge real estate portfolio that is not doing well, I also am a little bit comforted still in having real estate because it is such a good hedge against inflation. And, one of the things, one of the predictions out of the many things that could happen, right, is that this administration is going to use inflation as a way to drive down the value of the deficit, right? So these trillions of dollars, they're going to make them worth less and less and less. But that means that prices are going to go up and up and up. And real estate is a good hedge against that, right? Because the values of the property go up, the value of the rents go up. And so that's one of my few silver linings right now on holding this underperforming real estate portfolio, is that I'm like, okay, well, this is a real asset, right? And so this would be a good hedge against inflation if we do see this happen at some point.
Yeah.
I want to
Well,
make sure. Oh,
I was just going to say, Penelope, just to answer your question about the Vanguard Digital Advisor. I mean, I think that's a great choice. I don't have a recommendation of one digital advisor necessarily over some of the other big names, in terms of brokerage, you know, brokers that you might have or have heard of, including Betterment. I know that that's a pretty good one too. I think Vanguard has pretty low fees, like, um, compared to other digital advisors. And I have no reason to think that they don't do a good job. It depends, I think, on what you're looking for. Digital advisors are not giving you like personal support and really not tailoring anything to what your goals are, but at the same time, they're doing things for you like certain levels of reallocation and tax loss harvesting and things like that that are perks. And if you are looking for a digital advisor, I think it should also mean that you are someone who feels like you can be a little bit hands-on and you're kind of managing your digital advisor because you're not having a human to interact with there. So it's kind of a nice in between of I don't want to totally DIY this, but I don't want to, pay higher fees or a bigger flat fee and work with a human advisor. So I think that that's a great role that a digital advisor can play for you and your money. And then as far as they go, I don't think you're really going wrong in choosing Vanguard.
Yeah, and that even plays into what we were talking about with portfolio allocation. So a nice thing about a digital advisor is they will look at your time horizon. Normally, that's one of the questions they'll ask you is, your age, when are you looking to retire? What is your level of risk tolerance? And they will set up that portfolio allocation for you. So if you're having a lot of uncertainty about, how much to put in the US stock market and international and commodities, so the digital advisor will do all that for you. So that can be a good way if you are looking for like a hybrid approach where, like Caitlin was saying, you want to be a little bit hands-on, but you also don't want to pay these huge, management fees for a full financial advisor. The digital advisor is a really good way to go.
I was going to throw something back up here on the screen just to address, I think it's really weird and we've kind of all echoed it in what's been shared in the chat and some of the questions that you're asking is like it's weird to feel so much concern about the economy while at the same time seeing the stock market like totally go off the rails. And one thing that I wanted to share is why sometimes that can feel a little bit distorted, or why I think it is distorted. And first of all, I want to just clarify, the stock market when the stock market is booming, that does not mean that our economy is booming. And what we're seeing right now is a great example of why that is. So the wealthiest 10% of Americans are holding 93% of all stocks. And actually, there hasn't been data released in a little while on this. And this has been going up and up. It was the highest in history last year, and I think that it's even higher than this. So that's just something that really shines a light on wealth disparity in our country. But not only that, it's signaling that when you see the stock market like really blowing up, who's benefiting from that? It just continues to become like the wealthiest, fewer and fewer in our country. And then what's happening on the flip side of that too, or not, I shouldn't say on the flip side, but as a result is we're also seeing that the wealthiest 10% of Americans account for 49% of all of the spending in our country. So this is also like one of the highest levels on record. And this is distorting our economic outlook because we're seeing, oh my gosh, like spending is still really strong, but that spending is happening within the top 10% of wealthy people in our country. So it's really not reflecting what's happening to most of our country. And that's why we see the Fed kind of hesitating here to say, wait, okay, so our spending is actually pretty good, but our jobless claims are so high. And stock market is great, but like people can't afford groceries. So what is going on? And this is I wanted to present these stats because that can help explain what is going on. Because I think like we have so many contradictory signals right now. And I want to clarify that when we see the stock market booming, it can make us feel good, especially if you're invested. So that's something to say, like, if you're not able to invest right now, or if you don't feel like your portfolio is really strong, if there is a way for you to get to a point where you have a higher savings rate so that you can invest, you'll be someone who can actually reap the benefits here. that doesn't solve the systemic issue of wealth disparity in our country, but it at least gives you the opportunity to start investing, to start reaping some of these benefits. So, I want to also clarify that the point of this call, I don't want to set a tone of like, oh my gosh, this is so scary. We got to get out of the stock market. Like that's not true at all. There might be some telltale signs of what might be happening with the U.S. economy, at least temporarily, of what might be ahead of us. But still, like I think that the overall message here is that if we can invest, if we have the ability to invest, we should rely on that strategy because we see that the stock market has been a way to make the wealthy people in our country even wealthier, despite that people in our country who are financially struggling are really not able to reap these benefits, and their numbers are not reflecting, often what we see in the news and what we see in our portfolios.
Yeah, I definitely agree with that. I think we are seeing more and more wealth disparity, and it'll be interesting to see how that plays out. We are seeing a lot of parallels now, and again, this is not like to scare anybody, but we are seeing some parallels. There was, the Spanish flu pandemic in 1918, and then the Roaring 20s, very similar to what we're doing now, what we're seeing now, and then the Great Depression, right? A rise in tariffs, and suddenly the country fell into the Great Depression. So I don't know that we'll necessarily follow that pattern, but we are seeing some of the same things again. So I think that's why staying diversified is really what's important right now, right? Making sure you don't have all of your eggs in one basket, so that if something does happen, you will have some asset that's still okay, right? That you can live off of. And maybe that's, a little bit extra cash that you're holding back right now. Could be bonds, could be gold, it could be the S&P 500, right? Maybe that's going to take off and everything else will drop, right? And so I think diversification really is the key.
Yeah, and just to share one more thing, we saw the faucet analogy before, and going to bring this back to the Fed. I think based on what we talked about, the Fed can see these different factors playing out, and you can see that the Fed chose to lean slightly towards favoring those factors that it sees of rising unemployment and, rising um, inflation and uncertainty, and it's deciding to lower rates slightly, maybe trying to strike a balance of stimulating a little bit of growth and trying to promote more hiring without really sending prices up. And the balance that the Fed has to strike can be a little precarious because right now we're in a situation where inflation has been high and unemployment is on the rise. And because the Fed usually tries to use this faucet to be able to either like up one or the other, right now both are happening. So the Fed is in a dilemma, right? It's like, okay, how do we tamp down inflation and the unemployment at the same time? Well, it has this tool to do the opposite. So the Fed is experiencing this bit of dilemma. There's obviously a lot of political pressure that we haven't seen historically that is placed on the Fed right now. And so it'll be really interesting to see what happens in the next few months as far as the Fed rate goes, because there is a lot of pressure on the Fed to drop rates significantly. But if inflation keeps going up while we have high unemployment, we can be in a period of stagflation, which we haven't seen really since the 70s, and that's a pretty tough economic time to be in. So just to bring it all back to the Fed rate and talk about why this kind of boring concept is actually really important to our lives right now, and what the Fed is signaling by having just lowered interest rates a little bit but what can be precarious in the future if this is a pattern that gets stronger, in the coming months. So if we see bigger hikes and unemployment doesn't improve, we can be in a pretty dangerous economic situation.
Yeah. Because the prices will start to go up, but wages won't go up, employment won't go up, and we'll hit that stagflation period again.
We're coming up to the end of the hour. Please don't hesitate if you have more questions to pop them in the chat. If you want to come off of mute, even after we wrap up, we can pause the recording or keep it going if you want to ask a question on the record. Don't be shy about that. But if these kinds of conversations are something that you want to dive even further into, we have a program where we do a lot of live coaching and more group calls where we really dive into money talks and specific money situations for members of our Wealth by Design program. So there's information here if that's something that you're interested in. And you can always reach out to us to ask questions about that. But the other thing that I want to mention is that our next Wealth Wednesday is November 5th. So these will be taking place on the first Wednesday of every month. Next month, we're going to be talking about open enrollment and making sure that you have your benefits questions answered. I know that open enrollment it's like the worst time to have to do benefit selection, like right before the holidays. And there's always a lot of confusion around what health plan do I choose? What does this benefit mean? Can I enroll in both of these things? How much value am I getting from my employer through this if I don't take advantage of this program? So we're going to have a conversation where we can really talk about all of those perks, what they mean, and make sure that we answer your questions about it. So we hope that you'll join us next month. And that's a wrap. But as I said, feel free to ask us any questions if you have some more. And then you can always shoot us an email at hello@risingfemwealth.com ahead of these calls if you wanted to ask a question that we can address on the call for you. Thanks so much, everybody, for joining.
Thank you.
It was great to see you all. We'll talk to you soon.
All right, we'll see you next month. Bye.